Okay, let's dive right into this explainer by asking a question that kind of flips traditional financial advice completely on its head. What if the secret to building real, lasting wealth actually starts with how you handle what you currently owe? We're always told to just save and invest, right? But today, we're going to break down the specific mechanics of clearing your liabilities, specifically focusing on how the Snowball versus Avalanche works so you can unlock true financial freedom. So, is all debt created equal? Absolutely not. We are going to completely debunk the myth that all debt is inherently bad by looking at some incredible insights from top financial educators and fund managers. We're going to unpack exactly what the experts do differently when it comes to managing liabilities. Because it's not about avoiding debt entirely, it's about mastering it. Section 1. The two faces of debt, setting the foundation for wealth.
Before we even look at repayment methods, we really have to understand the fundamental difference in how debt functions in our daily lives. Financial expert Nisha draws a pretty hard line here between two very different types of debt. On one side, we have good debt. Think things like student loans that can lift your long-term earning potential, or a mortgage that helps you acquire an asset that's likely to appreciate over time. But on the exact opposite side, we have bad debt. We're talking credit cards, payday loans, those short-term finance deals. They might seem harmless at first glance, but behind the scenes, those compounding costs are actively draining your wealth way faster than you can build it. Check this out because this is crucial. Nisha points out a very specific mathematical threshold, 8%. Basically, any debt with an interest rate above 8% is mathematically toxic. Why? Because it is incredibly difficult for any of your stock market investments to consistently outperform an 8% return after accounting for inflation. That 20% credit card debt, it's a literal wealth killer. You absolutely must clear it before you even think about investing.
Moving to Section 2, the debt avalanche method, conquering the math. So, if you're looking at your finances and realizing you have multiple sources of this toxic debt, we need a strategy to eliminate them, starting with the mathematically superior approach. Enter the debt avalanche. This method is like dropping a massive weight on your most dangerous debt first. You completely ignore the total size of your loans. Instead, you rank them purely by their interest rate, going from highest to lowest. You pay the minimums on everything just to keep the banks happy, but you take every single extra penny of your cash surplus and hurl it at the debt with the highest interest rate. Once that one's dead, you move down the mountain to the next highest rate. Nisha sums this up perfectly, saying the avalanche method is the most mathematically efficient way out and will save you the most amount of money. And honestly, she hits the nail on the head. If you want to save every penny possible against the banks, the avalanche is your path for sure. It stops the most aggressive compounding interest dead in its tracks. But Section 3, the debt snowball method, conquering the mind. We are just
calculators, are we? We don't always operate on perfect spreadsheets, which is exactly why our sources offer a second, highly effective alternative. This brings us to the debt snowball. It literally builds momentum like a snowball rolling down a hill. Here, we completely flip the script. You rank your debts from the smallest total balance to the largest, completely ignoring the interest rate. Again, pay your minimums across the board, but this time you attack that smallest balance first. Why? Because you want to knock it completely out of your life for a quick, decisive win. Getting that quick win is just incredibly powerful. The snowball method might cost you slightly more in long-term interest compared to the avalanche, but it provides something money literally can't buy. A hit of dopamine and pure psychological motivation. Seeing a debt completely crossed off your list builds the confidence you need to stay in the fight. You roll the payments from the first cleared debt into the next one, and the snowball just gets bigger and faster. Section 4. Math versus human emotion.
Choosing your path? Let's see how these two methods force you to make a pretty big decision about your own money personality. When choosing between these methods,
You are ultimately choosing between mathematical efficiency and psychological motivation. The truth is, the best method is simply the one you're actually going to stick to. If you are deeply analytical, the Avalanche is going to satisfy you. Actually, let me rephrase that. If you've tried budgeting before and lost steam, the Snowball is likely your best bet to ensure you keep taking action month after month. And this conflict between math and emotion, it isn't just about debt. Fund manager Ashish Somaya echoes this exact sentiment when talking about high-level investing. He says making money in the market is less maths and more psychology. Despite having analysts crunching numbers all day, he argues that human behavior almost always overrides pure math when real money is on the line. Somaya points out that
financial extremes act exactly like a roller coaster on our emotions. When the market is up, people feel invincible. When it crashes, they panic and sell at the exact wrong time. This perfectly explains why choosing a debt strategy you can mentally stick to during the stressful times is way more important than having the perfect mathematical spreadsheet. At the end of the day, your behavior dictates your success. Section 5. Leveraging debt for wealth. Crossing the bridge to assets. Okay, so once you have crushed your bad, toxic debt using the Snowball or the Avalanche, our sources show how the wealthy flip the script and actually start using debt to their advantage. Financial educator Robert Kiyosaki drops a pretty provocative idea here. He says, I use debt to invest. The more debt we use, the less tax we pay. Wait, what? Well, he points out a massive historical shift. Since the US dollar was taken off the gold standard back in 1971, money essentially became debt. Because of this, the financially educated don't run from all debt. They use it as leverage to acquire assets, which comes with some pretty incredible tax advantages.
Kiyosaki emphasizes that shifting from earned income, the money you trade your time for at a 9-to-5 job, to passive income is the ultimate goal of leveraging good debt. Passive income flows directly from assets like real estate. Because you are using debt to buy the asset, the income it generates often completely bypasses the heavy taxes placed on traditional employee wages that get taxed before the money even hits your bank account. We see this exact theory put into practice by Ashish Somaya, who gives us a textbook real-world example of this leverage. When he invests in commercial real estate, he only puts down about 35 to 40% of his own capital. The bank funds the remaining 60%. But the genius part? He doesn't pay that loan back with a salary. The tenant's rent covers the bank's monthly loan payment. He's literally using the bank's money to own an appreciating asset. But listen, here is the absolute critical takeaway connecting all our sources today. Leveraging debt is an incredibly powerful tool for the wealthy, but it is deeply, deeply dangerous if done out of order. You can only use this leverage safely after you have cleared out the bad, high-interest consumer debt that's draining your financial foundation. You simply have to play defense before you can safely play offense. So, taking a hard look at your own money personality today, will you choose the Snowball or the Avalanche to conquer your debt and begin building your wealth? Are you going to ride the momentum of the Snowball or crush the math with the Avalanche? The choice is entirely yours, but the time to start is right